I'll get to the virus question and reopening trade in just a moment. Let's just set the stage here. On a benchmark level, these next 3 months, do you think we'll be range-bound likely, or do you think we'll get a rally?
I think it's still going to be range-bound because, if you look at a few fundamental factors, number one, you mentioned about COVID. We are currently still in the outbreak phase, so it could still lead to a lot of uncertainty in terms of lockdowns, in terms of disruption to the GDP and the market. Secondly, if you look at the property market, April is still a peak season in terms of the property bond repayment, and again, that could see more event risks. Finally, more fundamentally, we think that GDP growth and corporate earnings are unlikely to bottom until probably first half next year. Market will lead fundamental, but not lead by that long. Market will probably bottom somewhere second half this year. So we are still cautious on the next 3 months market performance.
Okay, but you're also saying when it comes to the reopening trade, now is the time to do that. Do you still feel the same way given the news flow out of Shanghai this week?
Yeah, I mean, we are watching the situation very closely. Amid the current outbreak, we understand that things could turn worse before it turns better. The control measures, the lockdown measures could get worse. However, we do think China will need to reopen in the next, 12 months. And also, even without a border reopening, just from domestic consumption perspective, this COVID waves comes and goes in a couple months' time. So, in a couple months' time, we should see a recovery of domestic consumption when those lockdown measures reduce. So that should benefit, the restaurants, the beer names, the movie entertainment, the more domestic focused, the hotels and airline stocks.
I have to wonder, I mean, everyone's waiting for some kind of action. You have, local media saying a triple R cut could be coming in the second quarter. I'm just wondering, Winnie, does a policy bottom signal a market bottom to you?
We think it's not necessarily the same time, right? Because market driven are driven by different factors, right? There's the valuation, there's the client positioning, there's the earnings. Policy is certainly an important factor if it's a very strong signal. However, we wouldn't consider triple R cut as a very strong signal. This would be like the 14th triple R cut in the past 3 years already. So I think it's incremental, but not a strong signal. Even the LPR rate cut, again, that's probably more an incremental policy, not strong enough to change the direction of the market overall.
And we were just talking about Sunak China. They're going to be citing earnings delay. We've seen a couple dozen companies already saying due to the COVID concerns and they're just not able to publish their audited results. How much visibility is there right now to you, Winnie? And what signs are you looking for of when these earnings downgrades are going to start to reverse a bit?
Yeah, I mean, so far for the companies, Asia companies that we tracked, the result, the companies that have been reported the result is pretty much 2-1 miss to beat, right? So, we've been saying that this year policy risk might decrease, policy may become more supportive, but earnings risk will be dominating the market. So far, MSCI China, consensus earnings forecast for MSCI China this year is still like 11-12%. We think that's too high. We think it's probably mid-single digit or mid-low single digit, potentially going to zero or negative by first half next year. So we probably need to see consensus being revised down low enough before we see the earnings upgrade.
Winnie, the big banks are coming out with earnings later today, at least the big four. They're cheap. Do you think the window, though, to add exposure to Chinese banks, given your outlook that this market might rally sooner rather than later, is that window closing?
Yeah, we think, if you look at historically how the big Chinese banks perform, they are low beta defensive names, right? They underperformed in the big bull market, 2007, 2017, 2020, they underperformed. But in bear market, they did outperform, last year, year to date, and previously 2018, 2008. So our view is that it will remain volatile for the next quarter. So for the next quarter, banks are probably still good defensive hiding places, cheap valuation, good earning certainty. But from a longer term, 6-12 months perspective, when China market does rebound, banks are unlikely to lead the rallies.